So let's talk about an income statement. Now we know what an income statement is at this point. It's revenues less expenses, which gives us the profit or loss of the company for a given period of time. But let's look at it a little closer. What does GAAP say about the income statement? Well, GAAP, generally accepted accounting principles, requires the statement, but is not very detailed on how the statement should be presented. In essence, GAAP states that a company should report revenues, expenses, gains, and losses from continuing operations, and it should report any discontinued operation or extraordinary items separate from income from continuing operations. There's a little bit of additional guidance, but that's the primary guidance that GAAP has given us, which makes the income statement a bit tricky, as there is no specific or given guidelines on exactly how the information is presented. So what we'll do is we'll look at a multi-step income statement, but keep in mind there are many variations on this theme in actual practice. So in practice of accounting, you have various formats for the income statement, all the way from a single step to the most advanced multi-step. And we're going to look at a pretty um, detailed multi-step statement. So let's look at an example. So we've got a trial balance for the Parker Company as of December 31st, 2013. And it lists out several items. We've got sales revenue, rental revenue, loss on the sale of investments, loss from tornado damage, cost of goods sold, selling expenses, restructuring costs, general administrative costs, interest expense, and then loss from write-down of inventory. Now let's read on. For this region, tornadoes are both infrequent and unusual. That's very important to know. And there were 500,000 shares of common stock outstanding throughout 2013. The income tax rate for this company is 35%. So what it's asking us to do is prepare a multi-step income statement for 2013, including the required earnings per share disclosure. So we'll talk about EPS disclosures a little bit later, and those are very basic EPS disclosures that we'll be discussing at this time. All right, so the first thing we want to do is define a multi-step. Well, multi-step breaks operating income from non-operating income. And then, of course, we've got the below-the-line items, as I like to say, which are required items that have to be reported separately, which are discontinued operations and extraordinary items. So let's talk about this. What's the actual format? Well, the first thing that all good financial statements should have is a header. Okay, so we're going to go in and we're going to do a header here, and we put the company name first, and this is just a generic header that we're going to do. And then the next thing we do is tell what statement we're working with, and in this case we're working with the income statement. And then last is for the dating convention. Now for an income statement, a statement of cash flows, and for the statement of retained earnings or statement of owner's equity, we always date these for a period of time. So it's just reporting basically the change for that period. So for the year ended, in this case, December 31st, 2013. Okay, so keep in mind the income statement is always for a period of time. Now the first thing we do on a multi-step income statement is always calculate the gross profit. Well, to calculate gross profit, we're going to take the sales revenue and we're going to subtract from it the cost of goods sold. This gives us what we call the gross profit. Also, you may hear that deemed as gross margin. Now, the gross profit, the sales revenue here is $2,500,000, and then we've got cost of goods sold when we look $1,300,400. Okay, and that brings us to a gross profit of, let's get our calculator out. So that's $2,500,000 minus $1,300,400, and that gives us $1,199,600 in gross profit. So that's our starting point. Now the next thing we need to label is our operating income. Now notice, or excuse me, our operating expenses. Now notice I did not include rent revenue. The only thing that goes in the top portion here are those sales revenues. That's our operating goal. What is the primary objective of our company? Well, in this case, it's a merchandising company, and our primary objective is to sell goods. So rent revenue is not part of our primary objective. Now, we may take advantage of the opportunity to earn additional funds by renting out space or renting specific items. I guess a good example would be like Lowe's Home Improvement. They have a primary goal of selling goods, But then on the side, they also rent some of those tools. So instead of having to buy a tool, you can rent it. Now, again, that may be beyond the scope of their operations. Their operation is to turn over inventory. But they may take advantage of that niche market and rent out a few tools to make that additional revenue, okay? Or they may have excess space in a warehouse that they lease out. Again, it's beyond the scope of their normal operations, but they're going to take advantage. All right, so let's talk about operating expenses. Operating expenses are those expenses are in the direct line of operating our company. In other words, they're helping to generate our operating goal, which in this case is to sell goods or products. So let's look, loss on the sale of investments. Is that part of our operating goal? Well, probably not. If you are a merchandising company, again, your operating goal is to sell goods. So this would actually be considered other income. Now, it is definitely part of our continuing operations because a company can buy and sell investments throughout its life. It's just not our primary operating goal. It doesn't match with our operating goal of sales. Now, let's talk about the loss from tornado damage. Well, when we look at that, we read on and we find out in our region this is an infrequent, unusual event. So, from that definition, since it is both infrequent and unusual, this is actually an extraordinary item. It would actually go below our income for operations on our income statement, be reported separately. Okay. Cost of goods sold we've already dealt with. Selling expenses. Well, when we look at that, do you need selling expenses to generate revenue? Well, absolutely. So that's definitely going to be part of our operating expense. Restructuring costs. Now, this one can be a little bit tricky. Some people want to say restructuring costs are extraordinary items. Well, that's not quite the case. Remember, an extraordinary item has to be both unusual and infrequent. Well, in this case, restructuring costs are, it may be infrequent in your company, but it's definitely not an unusual event. I think the statistics say like something like 50% of companies in 2011 or 2012 um, had restructuring costs. So that's definitely not an unusual event to happen in the corporate world. So for that reason, restructuring costs are actually part of your operation. So it's going to be part of our operating activity. It'll be an operating expense. Of course, general and administrative, you really can't operate without having those types of expenses. Interest. For a merchandise company, interest is typically considered other income or other expense in this case. It's not part of generating profits. And people want to argue, well, wait a minute, you had to borrow money. Yes, you use the funds to help you operate, but the interest expense that's accrued because of it does not actually help us benefit the operating goal of our company, so to speak. It's just an expense. So we put it into the other income expense. And then loss from the write down of inventory. Well, in a merchandising company, we must carry inventory at the lower of cost or market. So it is very common in the normal operations of the company to have to write down inventory due to obsolescence or just due to the price of the fact that the price has fallen in the market for that item and you have to write it down. So since it is so common, that is part of our operating expense. All right, so now that we've labeled out our expenses, let's go down and finish out our statement. So operating expenses, one, we're going to do our selling expense, and we have selling expense of $330,000. Then next will come our general and administrative expense, and that's going to be a total of $175,000. Then in addition to that, we said the restructuring costs were going to be part of this. And that would be $100,000. And then we said that the loss from the write down of inventory goes into our normal operating expenses, $215,000. All right, so if we properly label them, that gives us a total operating expense here, and our total operating expense will come out to, again, let's add those up. We've got 330,000 plus 175,000 plus 100,000 plus 215,000. We end up with 820,000 in operating expense. So the next line is going to be our operating income. Operating income would be your gross profit less your operating expense. So we had a gross profit of $1,199,600. We're going to subtract from that our operating expense of $820,000. So we have an operating income of $379,600. Now it's time for those other items. Again, other income expense, it is definitely part of our continuing operations. However, it's not part of our true operating goal, or did not result from our true operating goal. And in this case, we had rental revenue, and this company had rental revenue of 150,000. And then the next thing that we labeled as other was the loss on sale of investments. So we're going to go in and put that in the other category, and that was 31,000. Then the next thing that we had was the interest expense, and that goes under our other category as well. And interest expense came out to 83,000. All right, so that brings us to total other income expense. Typically we call this net. So let's see here. Our loss on investments was 31. That was a loss, so we're going to reduce the balance by that. Interest expense was an expense, so it also reduces our income. So let's see what's our net. We had 150,000 in revenue, minus 31 from the loss, minus 83 from the interest expense, and that comes out to a $36,000 net income. So we're going to leave that as positive because that's an increase. All right, so that brings us to our income from operations before tax and extraordinary items. Now, this line changes based on what you have below this line. It's always income from operations before tax, or it could be income from continuing operations before tax, especially if you have a discontinued segment. You're probably going to put the word continuing in there, so for income from continuing operations before tax. And since we have an extraordinary item, we labeled that loss from flood damage as extraordinary. We need to put on there that we have extraordinary items. So it's income from operations before tax and extraordinary items. And again, that is our operating income, and our operating income in this case was $379,600. And we're going to add that $379,600 to the 36 because the 36 was a positive. It was a net income, so to speak. So that's 36,000. So that brings us to our total income from operations of 415,600. I said 415, not 416. 415,600. All right. Now, once we have this point, the next thing we have to take into account is income tax. Typically speaking, in your principles class, you never dealt with income tax, but it is a very critical part of doing business. Really, you can't do business without paying your income taxes, so to speak. I guess you can, but it's probably not very legal. But we do need to take into account that our company has income tax. So in this case, it said that our company's income tax rate was 35%. So we're going to go in and we're going to say, okay, our income tax expense would be $415,600 times the 35%, which brings us to an income tax expense of $145,460. Again, you take the 415, that's your earnings before tax, so to speak. You're going to multiply that by 35%, the company's tax rate, and that gives us 145,460. So that brings us to our income from operations before our extraordinary item. Okay, so it's going to be the 415,600 minus the 145,460, which brings us to an income from operations before extraordinary items of 270,140. All right, once we get to this point, we will need to show our extraordinary item. Again, this is one of those items for GAAP that we have to show separately. So notice this is our income from operations. Two items have to go below this point. That would be our discontinued operations, which in this case we had no discontinued segments, and our extraordinary items. Now we had one extraordinary item and we had the loss from flood damage. And that was extraordinary for our region, so it's going to go below the line. Now, one thing we must always keep in mind, these must be shown, extraordinary items must be shown net of their tax impact. Now, since this was a loss and this flood damage, or excuse me, not flood damage, it was tornado damage. Sorry. So we had our tornado damage here, and since this was an extraordinary item for our region, we have to include it below the line. But anyway, this has to be shown net of tax. And we had a loss of 48,000, but really we wouldn't lose 48,000 because what a loss does is it reduces our earnings, and if a company's earnings go down, then its tax liability goes down. Okay? So what we need to do is say, yes, we lost 48,000. However, if you take that 48,000 times our 35% tax rate, that is 16,800 in tax benefit. So what we have to do is say loss from tornado damage, and we'd say net of 16,800 tax benefit. Because this is definitely a tax benefit. It's going to reduce the amount of income tax our company has to pay because we're taking this $48,000 loss. So to get our net loss, you'd take your 48,000 and you're going to net it with the 16,800. So we're really only going to lose 31,200 as a result of this flood, because by losing from the flood, it saves us tax expense. Okay, this is what we call the intra-period tax allocation. We actually split the tax between the items that create it, so to speak. So here, this is the income tax strictly from operations, the operations of our company. Then we're going to show the tax benefit from this extraordinary item separately, embedded in the extraordinary item. So we're allocating the tax based on what caused that tax to occur. Same way when you have a discontinued operation, it goes down here below the line. Any tax impact of that discontinued segment must be shown with the discontinued segment. So we're separating out the income tax based on the part of the business that created it. Either operations created it, a discontinued segment created it, or an extraordinary item created that tax expense or benefit. All right, now once we have that loss in there, the next thing we have is our net income. Now, net income, of course, would be our income from operations, 270, 140, and we're going to subtract out our 31,200, and that brings us to 238, 940. That is the net income of the firm. All right. Now, you would have other comprehensive income if you did it as well, but we'll talk about that at a later date. So right now, let's go on in and do the earnings per share calculation. So earnings per share. It is a disclosure that we must make, and for our purposes, we're going to keep it very simple when it comes to earnings per share. We're taking the income that's creating it and dividing it by the number of shares. Now, when you're talking about earnings per share, we must disclose every line item below income from operations. So basically where we're going to have to start is right here at this 271.40. We have to show the earnings per share at this level, and then for every item that's underneath this. So the first thing we're going to do is we're going to take income from operations before extraordinary item. Okay? That's the first place we start. And to calculate it, you're going to take that 270, 140. You're actually going to take that income amount right there, and you're going to divide it by the number of shares. Now, in our problem, it states that we have 500,000 shares. So we're going to divide that 270, 140 by 500,000, and we're going to get approximately 54 cents per share. So that's how much we made per share of stock outstanding for that income from operations before extraordinary items. So keep in mind, you must always start there. Then if you have a discontinued operation, you'll show it separately. Now in this problem we do not. However, we do have an extraordinary item. So we're going to put that we have an extraordinary item, and we need to show the earnings per share for that extraordinary item. And in this case we had a loss of 31,200 from that extraordinary item. You're going to divide that by the 500,000 shares outstanding, and you get approximately 6 cents. So this flood costs us about 6 cents per share. Or not flood, I keep saying flood. This tornado, I apologize. For some odd reason, I've got our flood on the mind, and I'm not sure why. But this tornado has cost us 6 cents per share, basically, is how that breaks down. And then the last thing we need to show is the net income. So we definitely need to show the earnings per share on our net income. Now again, this is a very simplified earnings per share calculation. We'll definitely go into earnings per share more, but right now our focus is just getting that disclosure in. And for our purposes at this point in time, we're going to take those earnings and we're going to divide them by the number of shares outstanding. Now, there is a true formula, and you do have to take into account preferred dividends when we get down to common earnings per share. But again, for right now, we're just going to keep the very, very, very basic formula where we take the income divided by the shares for that year. All right, so net income, we had 238,940 in net income. So again, we're going to take this number, the 238,940, and we're going to divide that by the 500,000 shares we've got outstanding. And when we do that, we get approximately 48 cents per share. Comes out to 0.4778. So we're going to round that to the penny, so we got 0.48 cents per share in net income. So that's how we calculate our earnings per share. So keep in mind now, earnings per share disclosures have to always start at the income from operations before tax, okay, or before extraordinary items or discontinued segments. So keep that in mind when you are working these problems. So you may have 3 levels, you may have 4. If you had a discontinued op, you would need to include the discontinued op earnings as well here. All right, I hope this video has helped a little bit understand how to create a multi-step income statement. I apologize I can't get the whole statement on the screen here, but you should have it down from where you've written it down during this lecture. But it's just a multi-step, and these are always the layers. The only thing that really we haven't covered is the discontinued segment. So when you're creating an income statement, one, make sure you calculate your gross profit. Be careful to separate your operating and your other items out, okay? Again, if it's directly related to our operating goal, it's going to be part of our operating. If it's just additional income that we've taken advantage of, now it may be part of continuing operations, but not part of necessarily our operating goal, then it goes into the other category. Keep in mind, discontinued segments and extraordinary items per GAAP must always be shown separately from our operations. So they're going to fall what I call below the line. Below the income from operations, you're going to show the discontinued segment. You're going to include the tax benefit or tax expense of that segment in that section, okay? That's the intra-period tax allocation, excuse me. All right, hopefully this has helped. Have a great day.